A lot's been said recently about the US debt. Well, how does that impact US stocks and your investments? On October the 12th, the US House of Representatives approved legislation that temporarily raised government borrowing limits to $28.9 trillion. $28.9 trillion. Okay, this action staved off the prospect of debt default, but only until December. Can you imagine America defaulting on its debt? It's never happened. President Joe Biden will sign the measure into law before October 18th. So that's happened, which is the day the Treasury Department calculated it would no longer be able to pay US debts without congressional action. But how did it get to this? How did it get to the wire? And what does this action mean for the broader economy and US stocks and your investments? What's in it for you? Well, let's look at what is the US debt ceiling. Okay, late September and early October 2021 have been anxious times for the US economy and any of us invested in the US markets. Congress faced a tricky task. They had to reach a goal on the US national debt ceiling, or the government would run out of money to pay its bills. Failure to do so would have led the US to default on its debt, which has never happened. While this prospect has been put off until December, a solution needs to be found, and will it be found, for the longer term. We don't want this precipitating a market crash and a global recession, and in this crazy world at the moment, anything's possible. So far, Republican and Democratic lawmakers have been at odds over raising federal borrowing limits, also called the debt ceiling. Before the temporary agreement, the debt ceiling stood at $28.4 trillion. However, the national debt, which is the total that the government owes creditors, was $28.43 trillion. With the October 18th deadline, a stopgap bill was required to prevent the first default. Failure to reach an agreement would have meant the federal government would default on its obligations, including Social Security and payments to veterans. The debt crisis was causing some nervousness in the US stock markets. Republicans had been expected to block a third attempt to raise the debt ceiling. However, fears eased slightly once Mitch McConnell, the Senate Minority Leader, indicated his party would support the debt ceiling extension into December. Additionally, McConnell's announcement caused yields on one-month Treasury bills to drop. What would happen if the US defaulted? Well, Congress may have kicked the debt ceiling down the road for now, but an agreement still needs to be found. Otherwise, the US faces the prospect of a government shutdown in December. Now, stock investors won't be delighted about this prospect. Several headwinds are swirling at the moment around all of these issues, like Federal Reserve tapering. Analysts at Goldman Sachs have suggested that shutdowns, however, don't necessarily spell bad news for the market. However, there are several other factors that could still negatively impact stocks. Goldman's analysis shows that government shutdowns have historically failed to have a meaningful impact on equity returns. There have been 14 government shutdowns since 1980. During these shutdowns, the S&P 500's median returns were down 0.1% on the day of the shutdown, hardly budged, up 0.1% during the shutdown, surprising, and up 0.3% on the day of the resolution. Barely budges. The only exception was the most recent shutdown during December 2018. During this time, the S&P 500 dropped by 2%. However, Goldman's notes this decline was probably more driven by investors' fears about Fed tightening rather than the shutdown itself. While budget expiry doesn't have a considerable effect, therefore, debt limit deadlines do affect some parts of the market. Government revenue exposed stocks like industrials and health stocks underperformed the market during the 2011 and 2013 debt limits. Let me say that again. Government exposed stocks like industrials and health stocks. If a debt ceiling solution can't be found by December, these stocks are likely to be affected again. Well, what else could rattle equities? Goldman suggests that the macroeconomic picture is a better predictor of how the equity market would respond. For instance, during the 2011 and 2013 debt limit shutdowns, the S&P fell in 2011, but rallied in 2013. The big difference between those two was the broader economic situation. In 2011, there was a decline in economic growth. The S&P had downgraded US sovereign debt, and there was the European debt crisis. By contrast, the conditions in 2013 were far more favorable. The macro picture is causing some concern heading towards the fall and into December in any event. Global markets rose most recently last week as the US waited for Labor Department data. However, that doesn't necessarily give us more hope for the broader economy. So the bottom line, in summary, historically, debt limit deadlines don't have a major impact on the S&P 500. However, some caution is needed, because if Congress struggles to reach a more permanent solution to the borrowing limit problems, then we could see history not repeat itself and the market be benign, but instead sell off. For now, though, the biggest fears for equities come in the form of energy crisis, Fed tapering, and concerns about GDP. I hope you enjoyed this. Have a look at my campaignforamillion.com. That's campaignforamillion.com to teach people more about investing. And there's a whole bunch of free tools. Some of my books you can download as well. And it's all free, and it's to teach you to be a better investor. Thank you.